A crisis doesn't create free money out of thin air. It just moves money from people who have to sell, who borrow too much, or who simply panic, toward people who kept some cash, kept their rules, and kept their patience. In this video, we'll walk through 10 concrete ways that transfer actually happens. By the end, you'll be able to tell a real opportunity from a trap, and you'll see which moves are realistic for a beginner and which ones really belong to professionals only. Cash and liquidity reserve. Before any opportunity exists, you need something boring sitting in your account. Cash. The kind you can move today. In calm markets, cash looks like dead weight, slowly losing a little value to inflation. And that's exactly why most beginners feel this constant pressure to be fully invested all the time. Then the crisis arrives. Prices drop. And the only people who can actually do anything are the ones who already had money ready before fear took over. So cash here isn't the investment. It's the ticket that lets you walk into the room once the room finally has discounts. Without it, every falling price on your screen is just a story you watch other people use. Forced selling. The deepest discounts in a crisis usually aren't produced by news. They're produced by people who have no choice. Think about it. When investors buy with borrowed money, their broker can demand more collateral the moment prices drop. And if they can't post it, the broker sells their positions at whatever price the market is offering right then. Add in emergency expenses, fund redemptions, bigger players cutting risk on a fixed schedule, and suddenly you get a wave of selling that has nothing to do with what those assets are actually worth. That's where the abnormal prices come from. The lesson for a beginner sits one step earlier, though. Don't be the forced seller. If you can avoid borrowing against your portfolio and keep an emergency fund sitting outside the market, then a falling chart is just a question, not a verdict on your account. Regular investing. Most people clicked on this video hoping for a clever move. And the most reliable one is, honestly, almost embarrassingly simple. You invest the same amount of money, on the same schedule, into a broad diversified fund. And you don't switch it off when the news gets ugly. When prices are high, that fixed amount buys fewer units. When prices fall, the same amount automatically buys more. You didn't predict anything. You didn't guess the bottom. The schedule did the work. And the falling prices, instead of being your enemy, quietly became your friend. The hard part isn't the math. It's keeping that auto transfer running on the exact day your portfolio looks the worst. Which, of course, is the day it matters most. Portfolio rebalancing. If your money is already invested, there's a second quiet mechanism that turns a crisis into action, without any prediction. You decide in advance what mix of assets you want to hold. Say, a certain split between stocks and safer assets. When stocks crash, that mix drifts. Stocks shrink as a share of the portfolio, while the safer part grows in proportion. Rebalancing simply pushes the portfolio back to its original target, which means selling a little of what held up and buying more of what fell. You're not timing the market, you're not following the crowd, you're following a rule you wrote on a calm day. And that rule quietly forces you to buy low, exactly when your emotions would do the opposite. The quality versus value trap. A lower price isn't the same as a better deal. A stock can fall 90% and then fall another 100%, because companies do go bankrupt and shares can go all the way to zero. The discount only pays off if the business actually survives and earns money again. This is why the regular investing rule from earlier works safely inside a broad index. A few failures get absorbed by hundreds of survivors. But that same logic gets dangerous the moment you apply it to one collapsing company. Professionals can sometimes profit from troubled firms on the debt side, while equity holders are wiped out. But that's a specialist game, with legal claims you, as a regular investor, don't control. For a beginner, the takeaway is simpler. Separate buying the market from trying to catch one single falling knife. Defensive businesses. Some businesses keep selling even when households cut back on everything else. People still buy groceries, still pay for electricity, still refill prescriptions, still keep their phone connected. Companies built around needs like these tend to keep revenue more stable through a downturn, which is exactly why they get called defensive. But notice the boundary here. A stable business is not the same as a stable stock price. The shares of a defensive company can still fall hard during a panic because the whole market gets sold at once. What you're buying is a stream of earnings that's unlikely to disappear, not a chart that refuses to dip. Treat the label as a description of the business, not a promise about the price. Put options and hedging. Now we move from defense into professional tools, and we start with the one that looks the most like insurance. A put option is a contract that gives you the right to sell an asset at a fixed price for a limited time. If the market crashes below that price, your contract gains value. If the market does nothing, the contract simply expires. And the money you paid for it, the premium, is gone. The catch is timing and price. Almost everyone wants insurance after the kitchen is already on fire. And at that point, premiums get expensive, sometimes brutally so. Options can be useful, sure, but they aren't free protection. They're a paid bet with an expiry date, and the cost gets taken out of you whether the crash arrives or not. Short selling. This is the move you see in films. Someone makes a fortune from a crash, and it sounds glamorous. It deserves a more honest description. To short a stock, you borrow shares from someone else, sell them today at the current price, and hope to buy them back later at a lower price to return them. The difference is your profit. The problem hides on the other side. A normal buyer can only lose what they put in, because a price can fall at most to zero. A short seller has no such ceiling, because there's no upper limit on how high a price can climb. One unexpected piece of good news. One sudden rush of buying that pushes the price sharply up, and the position can turn into a loss that's bigger than the entire account. The mechanism is real, but the risk isn't symmetric. And for most beginners, it's the most dangerous tool on this list. Liquidity providers. There's a group that actually earns in a crisis without betting on direction at all. When panicked sellers want out right now and buyers are hesitant, someone has to stand between them and quote a price for both sides. Liquidity providers, often called market makers, do exactly that. They buy from the sellers, sell to the buyers, and keep the small gap between those two prices. That gap is called the spread. In calm markets, that gap is tiny. In a crisis, with everyone in a hurry and nobody sure of fair value, it widens. And the cost of trading right now can grow several times over. The practical lesson for you is pretty direct. When markets are chaotic, slamming the sell button to get out this second means paying that wider gap to someone else. A patient limit order, even one that takes a few minutes, can keep that money in your account instead. Fake guaranteed opportunities. The most expensive opportunity in any crisis is the one that promises to remove the risk. After months of losses, the offer of fixed monthly returns, capital protection, and crisis-proof yields starts to feel like sanity, not suspicion. It isn't. Real markets pay you for accepting uncertainty. And there's no honest product that pays a high, steady return while everything else is shaking. The words guaranteed, fixed, and crisis sitting together in the same pitch, that's not a feature. That's the warning. The mechanisms in this video don't promise certainty. They describe who gets paid, what they give up in exchange, and what can still go wrong. That's the difference between an opportunity and a trap. And in a crisis, it's probably the most valuable thing you can hold in your head before you click on anything.